Good afternoon, everyone, and thank you for joining us. Our special guest today is Guhan Venkatu. Guhan leads the regional analysis and outreach at the Federal Reserve Bank of Cleveland. He has spent almost 23 years lending his expertise and research skill to the Federal Reserve Bank, both in Pittsburgh, we'll forgive him that, and Cleveland. His research is focused on inflation, housing, and factors related to regional economic growth, and he is widely published. I'll highlight a few of his works: Foreclosure Metrics, Demographics of Inflation Opinion Surveys, and Forecasting Inflation. He's highly sought after for his perspectives on the economy, and probably the most last optimistic presentation he delivered was back in February 2020, when he was one of the featured presenters in a Fed talk when things looked rosy and US GDP growth was anticipated to be about 2% in this year of 2020. He continued to be sought after to guide and provide expertise during the course of the pandemic. He serves on the Ohio Governor's Council of Economic Advisors. He is a graduate of Leadership Pittsburgh, but most importantly, he is a graduate of Leadership Cleveland, class of 2020. And Guhan, you have just a few 2020 supporters with you today. With that, thank you, Guhan, for joining us today.
Thanks, Marianne, for that very kind introduction. And my thanks to the Leadership Center for extending this invitation to speak to you today. Hopefully the rest of the presentation will go a little more smoother than the last few seconds there. It is very, very nice to be with you, albeit through this virtual format, my bad hair and all. I was going to tell you that I tried to get a haircut before this talk. I wanted to look good for you all, but my barber and my backup barber both contracted COVID in recent weeks. I think they're doing okay, but that's an odd way to in an odd way, rather, that leads nicely into the presentation today. So as the title suggests, I'm going to try to give you 10-ish facts about the economy through this pandemic in 10-ish minutes and then turn to Q&A. So without further ado and any more talk about my due, let's go ahead and get started. So last week, we received the first estimate for fourth quarter GDP, which came in at an absolutely normal 4%. That, of course, is a change from what we had seen earlier in 2020. We had seen some pretty dramatic swings in GDP growth through the course of last year, as I'm sure you are all aware. You can see that in the panel to the left. In the second quarter, GDP fell by more than 30% at an annual rate. That was the worst quarterly decline since the current GDP series started in 1947. And by some estimates, perhaps the worst quarterly decline that we've seen since the late 1800s. In the third quarter, GDP rose by more than 30% at an annual rate. That was also a record, in that case, the largest increase in series history. Altogether, these developments leave the level of GDP about 2.5% below where it was in the fourth quarter of 2019, which is when we entered the current recession. This incidentally is quite a bit better than where we thought we would be even as recently as September, when Fed officials thought that we might end 2020 being down by something closer to 4%. So one way to think about the gap that remains is that it is close to the magnitude of growth we might expect to see in a typical year, which would be something closer to 2 or 2.5%. At this point, the forecasts I've seen, including those from Fed officials, expect growth to be similar to the pace that we saw in Q4, namely 4%, meaning we should eclipse pre-pandemic levels of economic output sometime this year. Clearly, one of the reasons that GDP growth has been somewhat stronger than anticipated relates to the significant income support households have received throughout this pandemic. So to unpack this chart a bit, the black line shows disposable personal income, which is income after taxes and transfers relative to its level in February prior to the pandemic. And the shaded bar segments show the contributions coming from various sources. What I wanted to draw your attention to are the blue bar segments. Essentially, these segments show that income from employment, including income earned by unincorporated businesses, fell sharply in the first few months of the crisis, And outside of October, this income has continued to be below February levels through the end of 2020. These declines in what are typically the primary sources of personal income have been more than offset by the assistance provided primarily through the CARES Act. First, as a result of the stimulus or economic impact payments provided to households, which I have highlighted here in gray, and second, by supplements to unemployment insurance income highlighted here in red. These transfers from the federal government were sizable. The net increase in income in April was more than 13%, roughly the increase in inflation-adjusted income we saw in the 5 years to the end of 2019. I'm sorry, I should have said next slide, please. So on to slide 3. One consequence of this increase in income assistance was a sharp increase in savings rates, which jumped to more than 33% in April and have since fallen back to around 15%, which is about twice the rate at the end of 2019. This increase in savings was likely from fortunate households like my own, which haven't seen a sizable reduction in their incomes, but also from stressed households trying to make these income transfers last as long as possible in an uncertain economic environment. The other consequence, of course, was more support for spending. Again, the red line shows spending relative to pre-pandemic levels, that is February levels, while overall spending remains lower than it was in February. Spending on goods, shown by the blue and orange bar segments on this chart, has seen strong increases since June as the country came more fully out of lockdowns. Of course, spending on services is where the weakness remains, as people continue to avoid activities that involve close contact or face-to-face interactions. I'll come back to this on the next slide, but before I do, it's worth noting that after increasing in the months since April, total spending actually turned down in the last 2 months of the year. If you squint, you can see that with the red line there. That's perhaps a sign that some households have or are beginning to outrun whatever they were able to set aside from previously provided assistance. So on to the next chart, slide 4, or slide 5.4. In terms of the weakness we've seen in the service sector, you can see that somewhat more clearly here. So to take a few examples, you can see that the amount of time spent in movie theaters remains close to 0. While air travel has seen some recovery, activity remains about 1/3 of what it was a year ago. And activity at restaurants, that's the gray line on this chart, after recovering, has drifted down through the last several months as winter weather constrained outdoor dining options. And an increase in COVID cases caused some people to pull back on planned gatherings. And some surrounding states, of course, also issued bans on indoor dining for some part of the last couple of months altogether. There's a relatively recent survey, this is as of mid-January, I believe, from the Ohio Restaurant Association, which noted that more than 80% of responding restaurants did not break even in 2020. Nearly 80% of responding restaurants have been operating at less than 60% of seating capacity because of government restrictions and customers' virus concerns. And roughly half said that they may be forced to close in the next 6 months if they continue to operate at current capacity levels. Next slide, please. On the other side of the ledger are goods producers, not a surprise, given what I mentioned a moment ago. So that is doing much, much better than what we're seeing in the service sector. While measures of manufacturing activity are still somewhat below where they were in February, survey measures suggest that this sector is seeing strong activity. So charted here is the ISM Manufacturing Index. This is data that we also got in the last couple of days. Despite the decline in January, that index has risen to the highest level we've seen since the summer of 2018. And as you can see on this chart, it's near its highs over the last several decades. One thing to keep an eye on, though, are supply chain challenges, which are numerous and various, it turns out, that could keep production levels lower than they would otherwise be. These issues, of course, are arising in part from employee outages related to COVID, so back to my barber, capacity constraints in the transportation network, which is leading to delays and disruptions, and unanticipated increases in demand for certain commodities or components. That last issue has arisen in auto production, where a shortage of computer chips, driven by businesses and consumers' demands for an array of tech goods through the pandemic, is currently hampering production and leading to temporary production shortages at some auto facilities. There was also, of course, a fire at a factory in Japan that supplies these computer chips. Still, next slide, please. Sales of goods have been strong, and notably so in rate-sensitive sectors. So autos, again, are a prime example. December auto sales approached about 16.5 million units. That's close to the 17 million units sold in all of 2019. Though the declines earlier in the year mean that the total number of cars sold in 2020 is closer to about 15 million units. Home sales have also, which is what I'm showing you here, home sales have been, pardon the pun, through the roof. Sorry, I've been telling that joke for a few months now. Though they've turned down somewhat more recently, sales of both new and existing single-family homes remain at levels that are higher than at any time during the previous economic expansion. In the Cleveland area, recent existing home sales have been about 20% higher than they were at this time a year ago, which is very close to the national trends. Strong sales have, of course, been spurred by mortgage rates that remain near record lows, sub 3% at this point still, but they've also pushed prices higher and inventories lower. So prices, according to two repeat sales measures, were about 10% higher than a year ago nationally in November, the most recent readings available. There's an index that's also produced for the metro area, and that too has shown increases of about 10% through the year ending in last November. And inventories of existing homes nationally are at less than 2 months of supply, their lowest levels on records going back to the early 1980s. So let's turn to the labor market. The most recent data for December showed employment declining rather for the first time since April by about 140,000 jobs. As was also widely reported, women appear to account for all of those declines, which is astonishing. Perhaps that's partly because of where these employment declines were focused during December, which was in leisure and hospitality, where women make up more than half of those employed. The sector shed nearly 500,000 jobs during December, and the sector includes the very types of industries I mentioned earlier, namely restaurants, theaters, and hotels, which have been among the hardest hit. That sector also accounts for about 40% of the 10 million or so jobs we've lost on net since the start of the pandemic. As you can see in the panel to the right, we initially lost more than 20 million jobs. So we've regained more than half of those jobs that the economy initially shed. Incidentally, that initial decline eliminated all of the job gains we accumulated through the course of the longest economic expansion on record, which just passed. Locally, though, the unemployment rate here is about the same as it is nationally, so just under 7% in December, we seem to be faring slightly worse when it comes to the employment recovery. We did see steeper declines than the nation, with the metro area shedding about 17% of its jobs in March and April, relative to about 14.5% for the US. And since that time, the US has been able to regain a somewhat larger share of the jobs that were initially lost. So a little bit more than 55% versus roughly half for the Cleveland metro area. Partly as a consequence, when you look at how far we are from our February employment levels and compare that to where other top 100 metro areas are, we rank about 15th from the bottom. Next slide, please. In terms of those being most affected by these developments, low-skill workers, typically those in so-called high-touch occupations shown in orange on this chart, have seen the sharpest declines in employment through this crisis. Roughly 16%, which is more than 3 times the decline seen among those in middle-skilled jobs. These lower-skill workers are, of course, those individuals in the industries that have been most affected by the pandemic. We might think that it's typical for them to bear the brunt of economic downturns, but if you look to the left of this chart, you can see that that's not actually the case. So during the Great Recession, which is shown there by the gray shaded area, the large gray shaded area to the left of the chart, it was middle skill workers actually who were seeing the strongest declines in employment, declines that largely persisted through the subsequent economic expansion. That tracks with work done by David Autor at MIT, who has written about the hollowing hollowing out of work, wherein the demand for many middle skill jobs has diminished largely as a result of technological changes. Many middle skill workers ultimately migrated to these lower skill jobs, ones that weren't as easily automated away. But as David Otter and others now note, they're concerned that the same thing may be happening with lower skill workers because of more things like more online shopping and working, for example, developments that of course have been accelerated by the pandemic. Next slide, please. Needless to say, small businesses have also been hit hard. So data from the SBA suggests that we came into this pandemic with about 30 million small businesses nationally and about 100,000 here in Ohio. Most of these entities, about 85% nationally, were non-employer firms, meaning that they were firms of one. While we don't have great data on the number of these businesses that have closed through the pandemic, we can try to make use of information from a scheduling and time tracking application used by about 100,000 small businesses nationwide. That's the measure that I'm showing you here, which suggests that the number of open businesses remains roughly 25 to 30% lower than it was in February. And also importantly, that there have been declines in those open through the last few months. If we were to translate this into a raw figure, it implies that about 8+ million small businesses have been shuttered nationally, a figure you may have heard reported in the financial or popular press. Nevertheless, I think we need to be a little bit careful in using this information to make these types of inferences. These data are not representative in the data that I'm showing you here. Instead, they are heavily weighted towards restaurants. And what we can see on this chart may mostly reflect much of what I mentioned earlier regarding the stress that that sector is seeing. There's another attempt to get at this question by a respected academic in California who tries to use the labor market survey that underlies the unemployment rate. He examines those in this survey who identify themselves as business owners and tries to track their status over time. Interestingly, his calculations suggest that the number of active business owners is essentially back to where it was in February. Next slide, please. In any case, whether we are back to pre-pandemic levels of open businesses or not, we certainly have not seen a sizable increase in bankruptcy filings. One of the very interesting and somewhat perplexing developments during this pandemic. Indeed, both business and personal bankruptcy filings have generally fallen through the course of 2020. We did see an increase in Chapter 11 filings from a number of prominent retailers such as J. Crew, JCPenney, Neiman Marcus, attesting to the stresses and structural changes in that sector. But total bankruptcy filings in 2020, according to the American Bankruptcy Institute, which compiled the data that I'm showing you in the panel to the left here, were at their lowest levels since 1986, and about 30% lower than the number of filings in 2019. The panel to the right shows a different data set wherein we can calculate bankruptcies specifically among individuals. That too seems generally to have drifted down in 2020, and foreclosure rates are hovering around 0.5%, both nationally as well as statewide. That's lower than when we entered the pandemic, though those rates are partly a function, the low level of those rates is partly a function of moratoria on GSE insured mortgages. One last point on this that's related to dwellings. Recent national data suggests that close to 90% of apartment tenants made a full or partial payment on their rents in January, which again suggests that at least some of the support that's out there is helping to forestall evictions and foreclosures, et cetera. I think there are two important things to take away from all of this. As I just suggested, various forms of assistance, including the willingness of lenders to work with their clients, have helped both businesses and households avoid bankruptcy and foreclosure filings to this point. I think the important question is whether we will start to see these measures move up sharply as support eventually recedes. So that, of course, will depend on how robust the recovery is. Next slide, please, sorry. And how quickly we get back to an environment that we would think of as closer to normal. So to echo the statement released by Fed officials last week, the path of the economy will depend significantly on the course of the virus. You can see on this map how we're doing when it comes to the deployment of COVID vaccines, both here and across the country, given vaccinations to this point, and assuming that the pace of increases are, the pace of increases that we've seen to this point, rather, it might be reasonable to think that roughly 10% of the population will be vaccinated every month, which of course makes the math easy. We could see 60% of the population vaccinated by the beginning of the third quarter. So will that be enough to return things to normal-ish? It certainly seemed so early on when experts like Dr. Fauci suggested that we would get to herd immunity when we had about 60 to 70% of the population vaccinated. But in an interview with the New York Times about a month ago, even before concerns that the new strains might be more resistant to the existing vaccines, he noted that he had been slowly inching his estimate up and that he now thought the figure was closer to 90%. I guess that's all to say that we can see the light at the end of this tunnel, but it remains unclear when we will be freed completely from its confines. So with that, I would be happy to take any questions. Sorry to prattle on for so long. Happy to take questions as long as, of course, they are not about GameStop.
Guhan, thank you so
Half
much. And we have had a few questions come in. So earlier in the presentation, you discussed income assistance. Can you define that for those of us on the call? What does that mean?
Sure. Yeah. So we got stimulus payments. So there were stimulus payments, checks to Americans. They were means tested, so they phased out above a certain income level. That income level, I believe, was lowered in the assistance provided in the fiscal package passed at the end of last year. So that's one form of income assistance households are receiving. There are also unemployment insurance benefits that have been supplemented by the federal government pretty significantly, in some cases, initially in the CARES Act, and then, of course, more recently with the federal legislation, again, passed at the end of last year.
And also, you mentioned middle skill jobs. And
Yes.
Can you give a few examples of what those types of jobs may be?
Yeah, absolutely. Great question. So many of those actually would be in manufacturing. So lots of, not just manufacturing, office automation would also be an example of that, but manufacturing is a very good example of a sector where you had, let's say, family sustaining incomes in an industry for many, many decades, where a lot of that work has just been automated away. So actually I was talking to a factory in the Toledo area where the individual mentioned that he had invested in a robot that was going to replace about 6 welders. And those welders, those wage levels for welders are also reasonably high. So those are pretty good middle skill jobs that are about to be automated away.
So looking at the housing market and with the increasing in pricing, any worries of either a housing burst, or do you anticipate the housing prices will go back down anytime soon?
Yeah, it's a very, very good question. I think we have seen a little bit of a fairly significant ramp up, so I would expect prices to start to come down. I think for us in particular, when you see price increases on the order of 10%, that's pretty significant for a metro area that's not seeing much in the way of population growth. But the one thing to say about this is I think homeowners are looking at their monthly payments, which of course are going to be much, much lower because of low rates. So that accounts for some of the increase in prices. But the other thing that I think is worth noting, so if people are concerned that demand is going to start to really dramatically decline, a lot of commentators have pointed out that there are a cohort of millennials that are kind of approaching what's typically first-time home buyer age, and they're going to be sort of moving through the pipeline, probably helping to support home transactions and home prices.
So as we look ahead, and if the virus is going to be impacting national leisure activities through the summer, should we expect to see an avalanche of restaurant closing bankruptcies, despite not having seen that so far?
It's a very, very good question. I think a difficult one to answer. I think there are maybe 2 things to point out about this. So we need to get through the summer, of course, and there has been a fair amount of assistance that's been provided most recently, again, through the another round of PPP lending that should be helpful. So the idea is to try to get small businesses in particular kind of through this period as we try to get to the other side, we'll see if that support is enough. So I mentioned what the Ohio Restaurant Association is seeing in its surveys. I think that's a concern. I think the other thing to point out here is just retailers. So when you think about the comfort that individuals are going to have going back into retail establishments or to restaurants, that may last a little bit further, even once we sort of get through a lot of the vaccinations. So I don't know. I don't have a very good answer, unfortunately, but I think it's something that we should be concerned about and watch. And I expect to see some consolidation in that sector. Just one last thing to note on that. So when you think about commercial real estate, it's going to affect that sector too. And I think you are starting to see that when you look at CMBS, the CMBS market. But it's also the case that I think payments from tenants in retail, restaurants, et cetera, that's tended. So I mentioned apartment rents or apartment payments, rental payments. I think it's also held up better on the commercial side than many people had expected, again, from tenants like retailers, restaurants, et cetera.
We've had a couple questions come in around the proposed stimulus package and the potential for impact. Will it make an impact, especially with a lens towards Cleveland and Northeast Ohio?
Yeah, so in terms of, I guess the way I would think about the stimulus package that's being discussed right now, I think it's going to continue to support economic activity. So to that extent, that's going to be important for the region. Whether there are kind of longer term investments that help us sort of from in a structural sense, build sort of a stronger foundation for the local economy, that it's a little less clear to me whether that will be the case. I know that there's some discussion about that in the package, and I think the current administration is sort of also thinking about ways that it can support the manufacturing sector more actively, which would be important for us. I guess I'd use that question as a way to also say that the news about the Cleveland Innovation District that's come out in the last couple of days, I think that's also kind of important and critical. And the one thing that I'd mention on that is there have been studies. So I mentioned the manufacturing sector a moment ago. That's important for us. But when you look at the spillover benefits, they seem to be much more significant in so-called innovation industries. So by one estimate, one innovation job produces another 5 locally, whereas it's something like 1.5 for manufacturing. Those estimates are a little bit fuzzy, but the point is that the news on the Cleveland Innovation District, I think, it's good news in terms of thinking about the longer term trajectory of the Cleveland economy.
I have a question around, are the prices of consumer durable goods stable or decreasing? And if you could also comment related to that on inflationary trends.
Very good question. So on consumer durables, I would have to check the statistics so I can get back to you on that. It's typically been the case because of, imports, basically. So we've been able to take advantage of low wage rates from around the world. So goods prices have typically been falling over the last several decades. That's usually the pattern. In services, inflation is typically what's a little bit above the overall measure. So if you're thinking about inflation of 2%, you might see services inflation of something like 3.5%, which is closer to like the wage increases that we would tend to see annually. So I don't have a good answer on durables, but the one thing that I would point out there is some of the supply chain issues, also related to port congestion, has meant that some of those items have been in shorter supply. We've seen that for a number of types of consumer durables, outages, price increases. We heard about that from appliances. We've seen it with automobiles. So some of those price increases have gone up, again, because of the delays and disruptions caused by the pandemic.
So we have time for one more question. And as you look ahead to the rest of this year, to 2021, what excites you most about what you see on the horizon?
Great questions. So I think I'm excited, probably like many of us, to get out of my house, get a haircut, things like that. And I do think, I sort of ended in a somewhat pessimistic way, but I think that there is a light at the end of the tunnel. I think it's going to come relatively soon. And I think we're going to start to get back to something that is closer to normal. So I'm looking forward to that. I think, you know, as I suggested, there are initiatives in the current administration that could position us well, or at least there's talk of that. So that's positive. But I'd also, you know, I do think that the Innovation District and some of the other things that are in the air that are similar, I think are exciting and likely to be very important, again, for kind of moving the needle in terms of Cleveland's longer term trajectory.
Well, Guhan, we thank you so much for your time and insights today. I think this has been incredibly helpful to get a snapshot of where we are and where we might be going. And thank you for sharing your insights with us.
Thank you. My pleasure.
I'm going to turn it back to Marianne.
Thanks, Rachel. Guhan, that was amazing. The wealth of information in your brain is absolutely staggering, and we're grateful that you shared a little bit of that with us. So thank you for making time to join us today.